SCHD just had its big reconstitution here in 2024, and so I want to give you my thoughts on what I'm seeing. A lot of people are freaking out because they did take away a lot of pretty big companies, and I kind of don't understand one of the companies that they pulled out because I really like this company. I think long term this thing is going to crush it. But then again, we have to understand that there is a system, there is a method, and honestly, this method has been working. Now I'm not going to wait and make you wait all the way till the end of this video to see what I think and to see what the new reconstitution is. Right away, what I think this is going to be good. I'm going to explain why it's going to be good, but I see a higher dividend because of what they just did. And as far as the new reconstitution, here it is. They basically took out Merck and put in Bristol-Myers Squibb. But as you can see, the new holdings here, and this is the supposed percentage, so I'm interested to see how this actually does. Some companies that they pulled out was Broadcom up at the top there, AVGO, Merck, MRK, ADP, and then really notable was Triple M, which we kind of have been waiting for them to pull that one out. Here's a bunch of the other ones that have been taken out. The new Reconstitution 2024 changes emphasize dividend safety over dividend growth. SCHD's free cash flow to total debt, return on equity, and dividend payout ratios all improved. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. After looking at this list, I want to hear from you. What do you think is the most important company that they just added? And also, which company are you kind of frustrated that they took out? Now, just as a reminder, and this is very important to understand what just happened, SCHD tracks a market cap weighted index of 100 dividend paying US equities. Now, the whole selection universe of what actually goes into SCHD all centers around the idea that it only includes firms with a 10-year history of paying dividends. Within that universe, SCHD uses fundamental screens like cash flow to debt ratio, return on equity, dividend yield, and dividend growth rate to build its portfolio. The objective is to focus on quality companies with sustainable dividends. As such, this approach gives the fund a modest, large cap tilt and excludes REITs entirely. Individual securities are capped at 4% and sectors capped at 25% of the portfolio. Its overall composition is reviewed annually while the portfolio is rebalanced quarterly. So the idea is that as a fund, it needs to stick to these rules. And so that's why we saw them take out Merck and put in so much Bristol-Myers Squibb, because that was the healthcare play. And so they swapped one out for the other. Bristol-Myers Squibb is down a bunch over the last year at negative 23%. But it's slated to jump right back up, and it does have a nice dividend yield of 4.59%. So just like if we were to buy regular stocks, you want to buy them when they're low and on sale because then you get to have that price appreciation. This one, BMY, is down a bunch, so SCHD bought a bunch so that now it's big within its fund, and so those of us that own SCHD have a real shot of some price appreciation. And a really nice dividend yield there. Now, obviously, a bunch of people are a little bit frustrated with the idea of them taking out Broadcom, and I'm one of those. Broadcom, in my opinion, is one of the top stocks, one of the best companies to be owning. I really, really like that company. I like the dividend, even though it's low, I really like the price appreciation of the company, but overall, SCHD is a dividend ETF. They're primarily trying to keep higher dividend yield type companies. And so if one is massively underperforming the rest as far as dividend yield is concerned, and people are buying this ETF in order to have a higher dividend yield, it just makes sense that they have to kick that out. The good news though is that Broadcom is in the majority of your growth ETFs and definitely in your S&P 500 or total stock market ETFs. And so as long as you're doing my 3-fund portfolio, you're covered there. You pretty much have this solid company. And that's one of the reasons why I like SCHD so much, and I really like the moves that they make on this ETF. It's going to be companies that you wouldn't traditionally go out and get. And that's the whole point to have a multiple ETF portfolio. You want to keep yourself balanced. If all we did was buy things that had Nvidia in it, or Amazon, or Google, or Apple, or Microsoft, yeah, that's what we want to do because those are the most fun, those are the most exciting, that's what everybody's talking about. But that's not keeping you balanced. That's not keeping your risk low. And so that's what SCHD does. And so yeah, these are boring companies. This is not the funnest move in the world, but it is the whole reason to have this as part of your portfolio. But the big thing here is that the moves that they did make, it does look like the dividend yield should go up because of this. It looks like the new slate of firms has an average yield of about 3.6%, while the dropped ones has an average of about 2.66%. So it's dropping lower yield, less safe, and more volatile firms for higher yield, safer, and less volatile firms. Another point to consider is that with the current overall yield of 3.37%, if the drop firms made up about 25% of the fund, and then to balance out to 3.37, that means the rest of the fund had about a 3.6% yield. This means the new overall yield should be about 3.6% and will likely see a 6.5 to 7% dividend growth this year based on the reconstitution alone. This is how SCHD has grown its dividend by about 10% every single year for the past decade, and I just see that if it continues to do what it's supposed to do and we just stay the course and use this as a value dividend play, this is a very, very smart ETF to continue to invest in. I'm continuing to invest in this just like normal. I'm actually more excited with this reconstitution. I am a little bit frustrated with them taking Broadcom out, but I know that I have it in my other funds, so disciplined investing would say SCHD is still a great buy. When we look at what SCHD is, first of all, it's got a total expense ratio of 0.06, and as you can see, it even says the fund can serve as a part of the core or complement in a diversified portfolio. It tracks an index focused on the quality and sustainability of dividend. This is why I'm so big on making sure that you understand why you're investing in whatever ETF. Now, a lot of people are talking about possibly just dumping SCHD and just going into DGRO or something like that. And that would make sense if that's your only ETF that you're trying to hold whatsoever. Like that's the only one. Maybe I would say DGRO over SCHD. Only because DGRO does have fun companies. It does have your Microsoft, it's got Apple, it does have Broadcom. It's definitely a hybrid between a growth ETF and a dividend ETF. So I do see the allure there, I do see why people want that one, especially right now when those fun companies are in there. But if you're investing in a 3 ETF portfolio or multiple ETF strategy, it doesn't make any more sense to continue adding in more growth. You're going to have a growth ETF. You're going to have a foundational ETF that has a bunch of growth companies. Then you're going to add in a dividend ETF that's more growth. It doesn't really make sense. It's just overweighting your growth side. You might as well just invest in individual companies at that point. To keep you safe, like I've said 100 times today, SCHD is going to be your value dividend play. I still believe that it's going to have very solid dividend growth. I think the price appreciation is going to be there because it bought a bunch of companies that are on sale right now. They don't look great today, but buying at the bottom is smart because then it goes back up and hopefully you make some money. I'd love to hear what you guys think and what companies you were excited that they brought in and what companies that you're not excited that they took out. Go ahead and comment that down below and I'll make sure and talk about this more as we get more information.